Good afternoon, everybody. All right, Jason Foote, Property Director of Strategy. For those of you who haven't met me, I'll just give you a very brief introduction. We haven't done one of these videos for our clients, and it just seems like the perfect opportunity for me to introduce myself and have a chat with everybody because obviously the federal government with their budget, they're doing some moving and shaking, and it's just made us realize how well guided our clients are and how solid our strategies have been. And I've done this for my entire career. We're all sitting in a very, very good position, and it's opened up a whole lot of opportunities. So we thought it'd be a great opportunity to have a chat with all of you. So for those of you who don't know, I started investing in 96. I'd met my mentor at that time. When I met my mentor, he was 36 years old and he had 44 properties. And he guided me quickly to build a portfolio of 10 properties my first 12 months and then beyond after that. The basics that he taught me is something that I've carried my entire career. I've been fortunate enough to do the speaking circuit for nearly 5 years, and I've stood alongside some very, very prominent speakers in seminars, and I've always taught the same thing. Obviously, strategically, we duck and weave, right? And we obviously fine tune things depending on obviously what's going on in the economy, in the property market, and now, government policy. But the basics have always remained the same, and they've just never failed me. And everything that he's taught me has just held true through every single cycle. And I want to share some of those things with you today. And let's unpack a little bit about what the government has done and how much of a difference it just doesn't make to us. And the great thing about this budget is that I think you would agree it's probably one of the most audacious budgets you're going to see a government have. Look at their situation. They're trying to avoid being $1 trillion in debt. So they're trying to avoid being the government that tips that over. They're trying to avoid us going into recession. So they've got to maintain the migration, no matter what economic sense that makes or what criminal sense that makes, safety concerns, pressure on infrastructure, whatever. They are going to maintain, obviously, that migration rate. And no matter what the public outcry actually is, because it's keeping the GDP expanding and keeping them from recession. So, we've obviously seen that for a very, very long time. I mean, every time they say they're going to retract it, they don't, they expand it. So none of this is surprising to us. But the most important thing I wanted to try and convey to all of you today is that look at how solid our guidance actually is, and look at the opportunity that this now actually opens up and creates. All right, so let's scale back a little bit. Let's look at the reason why negative gearing actually exists in the first place, how it started, the history of it, and then let's take a shot of it where we are today. So negative gearing was actually introduced early last century. And it wasn't introduced to help people in their wealth creation for retirement, because back then there were 12.1 taxpayers for every retiree. And as a result of that, everyone was pretty comfortable with that. They worked in their same job for 30 years and then ended up with a retirement. They paid off their house and ended up with a nest egg in retirement. So people weren't worried so much about trying to invest and build up a portfolio as much as they were going to be taken care of. What economic security equaled back then was obviously being the same job forever. So the government introduced negative gearing and this is in the early 1900s, to encourage people to invest in property, to provide more stock to rent so that it brought rentals down. That was the driver for why the government introduced negative gearing. It's all about rental affordability. And so it's cheaper for government to provide, obviously, the funds to, tax benefit to an individual that's investing than it does for them to actually build government housing. And so that was the thinking back then. Then move along to the 1980s. So by the time we hit 1985, so by this stage, there's about 6 to 7 taxpayers for every retiree. And the Hawke government 1985 said the negative gearing is supporting the wealthy. Now, that's actually bullshit. It doesn't support the wealthy. Most wealthy people I know positively gear. They got more money. They put more money into the deal. They borrow less from the bank. And so ultimately, they're positively geared. All right. So It's not true to say that. It's actually a rhetoric, and it's basically a pitch, right, to say that it's supporting the wealthy. So they got the support of the people to say that we're going to axe negative gearing in 1985, and they did it with Paul Keating as the treasurer. Well, they reintroduced it nearly exactly 2 years later. And the reason they reintroduced it is because it actually spiked rents. Rents got literally out of control. And I've got articles on this from back in the 80s. So it was a disaster. And especially under a Labor government, I mean, what a disaster to make a policy that ends up pushing up rents. It's not like it was actually affecting the wealthy end of town. It was affecting, obviously, the blue collar worker and who they're supposed to be representing their constituents. So they reintroduced it. It then surfaced again in 2008. Julia Gillard, another Labor politician. Now, by the way, Labor Liberal, I mean, they're all bullshit asses as far as I'm concerned, but I'm talking about where their policies sit. And so she wanted to actually axe negative gearing as well. And Malcolm Turnbull, who was head of the opposition at the time, pushed back very, very successfully, and it was squashed. And he proved convincingly that negative gearing doesn't support the wealthy. It supports the low to medium income earners that are just trying to get ahead, because they need those tax credits for cash flow in order to support those investments. And so it gets pushed around in sort of, various elements. And again, I've been teaching people this, in my whole career, whether it be from stage or one-on-one. I'm very, very crystal clear on this. And what I've said all my career, and what we've taught all of our clients, is that if a government acts negative gearing and they grandfather that policy, so that means that anyone is currently negative gearing their property that they bought 2 years ago, 3 years ago, 10 years ago, they're currently negative gearing that, and they pulled that from every single person, that would have a monumental impact, not only the rentals, let's worry about that as a side issue, that would have a big impact actually on the median house price. Now, in the meantime, what's happened is that the loan to value ratio has shifted upwards. So at the moment, 2/3 of all the bank's lendings go to residential property. Around about 60.1% or 60 point, depending on what stats you read, it's around about 60% of the loans they are lend against the value of those properties. So if there is a shift in median house price that's 10%, 20%, 15%. It doesn't have to be a massive shift in median house price, because you've got to remember that's the median house price. There's obviously a big shift in the values of all sorts of other properties. If that shifts down, then you've got a banking collapse, and then we've got a much bigger problem with a banking collapse than we do otherwise. All right. So I have said always that the government, doesn't matter how dumb they are, which I don't believe that they're dumb. I think that it's driven by their agendas. But the point is that it won't get through Senate. It'll get too big a pushback from the commercial sector, and especially the banking sector. And you've got to remember too that, let's look at the banks. Great Depression in the 1930s. There was around about 5 to 6.5 loaned out, right, to their deposits. So they were allowed to lend more money than they actually had, right? And that's why when people wanted to pull their deposits out and they wanted to pull the cash out, the money wasn't there, and there was a run on the banks. And that's why our grandparents were renowned for, stuffing, cash under the mattress or burying it in the backyard. I know when my grandmother died, it was literally a treasure hunt for my brother and I. We literally found tens of thousands of dollars stashed all around the property, because there was a big distrust in the banks because they lived through that phase. Well, now, just so that you know, there's around about $12 of equity capital. That's basically, so $12 of deposits that are against $100 worth of loans, right? That's what's currently in place right now with the banks in Australia. So with residential mortgages, there's about a 25 to 30% risk profile. So that means there's $12 to every $300 to $400 lent. So we're looking now at not 5 to 6 times that are loaned out from their deposits. It's more like 25 to 35 times. So could you imagine, with now a higher loan to value ratio, if they accelerated gearing across the board and then grandfathered that policy, you wouldn't be worrying about investment property. You'd be worrying about getting money out of the bank. You'd be worrying about how you're going to eat, and crime would be through the roof. I mean, it would be literally chaos. So that's why I've said publicly for my whole career, if it happens, which I don't believe it will, then you won't be worrying about your property investments. You'd be much more worried about how I'm going to feed my family. And so that's why we haven't seen that. And even so, this is probably about the most audacious and bold budget that we're going to see from a government. I mean, correct me if I'm wrong. I don't think, with all of the pushback from everyone, from every single entrepreneur, the whole business sector, everyone is pushing back on this budget, right? No one is for it. That is definitely in the commercial sector. And even who it's supposed to support, being the younger generation, I mean, they're not convinced either that it's going to bring down inflation. So there is not a lot of supporters for the budget, and the government's digging their heels in anyway. And it's, there's obviously doubts about whether it's going to go through the Senate, whatever. Regardless, right? Let's say that everything holds true. You couldn't have a better position, right, than our clients are in, because just like we've always said, if they're going to reform negative gearing, they have to keep new properties. They have to, because they have to support the construction industry, because it employs way too many people than for them to do so. The other thing is that the government said is like they've admitted that there's potentially, because of these policies, going to be about 35,000 shortfall, right, of supply of properties. Well, that's in shortfall of supply, still with the migration. The migration requires 85 to 100,000 new builds per year. So what does that mean? We're up to potentially 135,000 shortfall, right? Like, it's just, it doesn't make any sense. But either way, they have to maintain negative gearing for new properties. So that means if you're invested in properties that are new and that are in new growth corridors, and if you're investing now in new properties, then obviously it's a very good investment, and they're clearly going to be the winners in property. There is no question, and no one is actually arguing with the fact that if you're in new properties that you won't win. And obviously it's not every single new property. There are still ways in which you can lose money really badly and still poorly invest, obviously. But that is obviously a clear winner. The clear losers are going to be people that have invested in established properties looking for the high yield, right? And as a general rule, that's taken them to regional areas, which we've always avoided, because regional areas, sure, they'll have migration, but nowhere near in the concentration of percentage point increases that they do in the corridors that we've always sourced properties. So the reason why those yields are 6%, 6.5% is because they're not growing very well, right? So the yields are high, but the capital growth isn't so great. Well, they're going to tank even further, because a lot of them are going to get dumped on the market, because a lot of those investors aren't going to be able to afford to hang on to them. So that's why in my whole career, when someone's come to me and said, oh, can you source me a property that's in this area and this country town, and that I could build a granny flat out the back, and you're talking to the wrong guy, right? You need a buyer's agent that can go and find something for you off market. Otherwise, jump on realestate.com.au, right? I'm not your guy for that. We are looking for properties that meet 3 criteria, whether they're a house, a townhouse, or a boutique apartment. They must be in an area that's getting a minimum yield of 4%, right, in the area. The area must be heavily gentrifying. So it must be the heaviest gentrifying areas in Australia. So therefore, that rules out a lot of the areas at any one point in time. If we looked at Australia now, we wouldn't be looking in Hobart. It doesn't mean that there aren't areas in Hobart that aren't gentrifying. It's just that there are areas in Australia that are much heavier in gentrification and population expansion. So what we want is young working people with a surge in population growth, and that there's construction that needs to be made to meet that demand. So that achieves 2 things. One is that there's already a disparity between demand and supply, and the supply is new, right? Which gives us the depreciable amounts, which creates cash flow of the tax credits, and therefore those areas continue to grow. Why does that always support what we've told our clients, and why have we always been resolute in that? Because it's the government that are actually wanting to grow those areas. It's the government that actually have the immigration policies. It's the government that are trying to protect the recession, right, and from hitting the bigger debt rates over particular thresholds. So it's because of those government policies that continue and have continued to do so over a long period of time, as to why then the big developers are there. So you could go to an area where there's a master plan, and then that master plan, the government might say, look, we want 10,000 young working people to work to live in this area, and therefore we're going to approve high density apartments. And so over time, big developers will come in, they'll buy that land, they'll get approved, they've got to meet all of the criteria that the government has laid out, and they will roll out sections off plan. And each time they launch a new section, they'll increase the price, which bumps up the price per square meter value of everything else. And of course, the other way in which that lays out is that the government will actually say, look, we want to expand this growth corridor in this particular area of this capital city. We want to increase it by this many tens of thousands of people, and we're going to roll it out over the next 25 years or 30 years. And so they then flag that to the top 5 land developers: Stockland, Lendlease, Peat, Mirvac, all the top 5 developers who are controlling about 300,000 house blocks right now. So if you control 300,000 house blocks in Australia, you are controlling the prices in Australia by how much supply you release. If you release that supply really quickly and you price discount, well, then you collapse the whole market. Obviously, that doesn't serve the purpose of those 5 developers that are predominantly public companies. So if they value all of those properties that haven't been sold yet on their balance sheet by the last square meterage rate of the last block sold in that area, or a collection of those areas, if they discount the price per square meterage rate, it discounts everything on their balance sheet, and they will obviously shrink in their value, and they'll have screaming shareholders and screaming banks. So they've never done it. Peat is a really good example. Peat, P-E-E-T, they're the 3rd biggest developer in Australia. They're the 3rd oldest company in Australia. They're the oldest developer in Australia. They've been around since the 1800s. You think about that. They've been through the Great Depression, 2 world wars. They went through Black Monday. They went through the GFC. They've been through a pandemic. They've been through so much, and they understand how obviously the economic cycle works. So and by the way, they were here when interest rates were at 17%. So when interest rates are really high and the market slows down, these developers don't discount their land. They just sell less of it. They only need to sell 1 block this year at a slightly higher rate than last year for it to dictate the value on their balance sheet. So they've got shareholders and banks at bay. All right. Now, I'll give you a really good example of this because I know these numbers. When interest rates were at 2% in Melbourne, on average per month, there was around about 8,500 to 9,000 blocks being sold per month. When the interest rates started scaling up after COVID because of the inflation, and we started getting these increases in interest rates, they didn't decrease the pricing, but they slowed down their sales, and they got down to as low as 1,500 sales per month for the whole of Melbourne. So they know that when the market is buoyant, they move all of their stock. But they don't get carried away with price. They don't spike prices when the demand's really high. They just keep it on the steady increase over time. And so we've always followed this policy. We've always gone to areas where there's really high gentrification, where there's an immediate minimum yield of 4% on the rent, and where there's obviously a lot of new construction trying to meet the demand. And so then the next challenge for us is, who do we want to work with in that area? Who's the appropriate builder? Who's the appropriate developer? So therefore we lean on our own experience. There's experience that we've had with those developers and builders in the past, but there's also an auditing process that we go through. I mean, our CEO, Tim, and his team, they've got exceptional construction backgrounds. They'll audit construction at different stages, and they'll go through to make sure that everything is kept at a certain level of quality so that everything is delivered. All right. Now, just on that, not everything always goes to plan, right? And that's a really important point. When you're talking about new construction, not everything goes to plan. So therefore, it's not about when something goes wrong. It's about how it's actually dealt with. And we've had circumstances where builders have made decisions, they've made mistakes, the tradies have made mistakes, and it's been corrected. And we've come to the party and we've helped financially, as well as we've forced the builder financially to obviously make those corrections. WA is a really good example. WA, they build a really good product. They're really good builders. They're really solid, but their communication is awful. Really, really awful communication. And it causes anxiety for our clients, it causes anxiety for us, but what they end up building is a really good quality product. And, we've had clients that have bought house and land packages in the northern and southern growth corridors of Perth with a 6 in front, and they've now got an 8 value in front, some of them 9s now, right? And they're just coming to completion, or they've already been completed and getting valuations come in. So it's not like it was a poor investment decision. It caused a little bit of angst during that process with lack of communication, but we managed the process. So obviously that's where our strength has been. That's what we've done in our whole lifetime as a company. All right, now let's come back to the budget. So we know that if there's going to be reform around negative gearing, then there is always going to be strength in when we're in the areas that we're in. And so that's why we've always maintained it. And when anyone has tried to pull us away from those areas, we've just been resolute and said no. Now, when interest rates were at 2%, and that period after the GFC, it went for 12 years, it would have been the most frustrating period for me in my whole career, and obviously as a team, because everyone you speak to is a property expert all of a sudden, right? Now, how could you not think that you aren't an expert when the market's booming so hard and the cost of money is really low, right? But the thing is that people don't think about what about when interest rates go up? What's your plan then? Is this a suitable investment when interest rates are higher? What about if the government reforms their tax policies? Is it still a good investment? Right? So there's not a lot of thought put into how am I going to move through all these cycles in a get rich slow investment. Now, you might be on an upward stage cycle and then try and exit, and then you've got a capital gains issue. Now, just on the capital gains issue, the capital gains policy hasn't affected our clients either, because we've taught everyone their transition to retirement strategy that didn't involve them selling their properties. They're either selling a self-managed super fund property and extinguishing debt on the other ones, or they're actually living on those lines of credit on those existing properties going into retirement and beyond. But we have never pushed a transition to retirement policy with a client where they then have to sell their properties and bear the brunt of capital gains tax. All that's happened is that capital gains tax has increased, right? So it's even more so our policies are actually even stronger, right, in terms of our strategies. All right, so let's come back to negative gearing, and let's come back to the type of properties that we're actually investing in. So we've never deviated from this policy of really high gentrification and minimum yields of 4%. And so that's pretty much why we've really found properties in New South Wales and Sydney, because it's very hard to find high gentrification with that yield. It's very, very hard to find. And then find obviously the sweet spot with the affordability, which comes with the yield, because as the price goes up, the yield comes down. And so I'm not saying there aren't opportunities in New South Wales. There are, and there have been. There's been opportunities in South Australia. There's been opportunities all around the country, but predominantly it's not always in those areas, even though we continually look all of the time. And it's a lot easier now with obviously technology for us to continue to look at all the markets all the time, but we won't deviate from our policies. So here's two really good examples. All right, COVID hit. Now, no one had been through a pandemic before in our lifetimes. And so a lot of people panicked, a lot of people were stressed. So we were like, okay, let's just follow the same policy. So they've shut international borders. So there's not a lot of gentrification around Australia, because gentrification means loads of young people moving to the area and the population increasing with young working people. So if there's no international migration, that stopped a lot of those other areas around the country, except for southeast Queensland. People are moving there in their droves from Melbourne and Sydney. So all of a sudden, we were looking at opportunities in House and Lands in Redland Bay. We were looking at that corridor between Gold Coast and Brisbane, right, for townhouses. And I'm talking about, 3-bedroom, 2-car space, 2-bathroom townhouses for $450,000. Some of them are $440,000. Some of them, at one point, they were less than $400,000. And so we were getting 2-bed, 2-bath, single lockup, single car space apartments in Maroochydore for just over $400,000. When they settled in 2023, I think it was, the valuations all came in at $690,000, $700,000, which people were able to borrow against. And all of those properties, the $580,000, 4-bedroom packages that were in house and land packages, everything is over $1 million now. All right. So a lot of people said, how did you predict it? Well, we didn't predict it. We just followed the same formula. So whether it's a pandemic, whether it's a GFC, whether it's high interest rates, or whether it's a government trying to actually reform policy, and they can only reform policy to an extent. All right. We've always followed the same basic strategy, which is minimum yield of 4%, maximize gentrification, must be brand new. And so for those people that invested in more regional areas, more established properties, they'll probably have to sell. And what we're going to start to see, we're going to start to see different spin markets. We're going to see a lower spin market in a lot of those regional areas, and we're going to see a higher spin market in those newer properties. And no one's arguing with that. Every single expert is admitting that that's exactly what's going to happen. All right, is that those newer areas are going to obviously catapult forward. And so for our clients that are already invested in those areas, they're winning. For our clients that are already on a strategy where they've got a self-managed super fund property in order to support their exit strategy at the end, they're already winning. So what's happened already, and this is what we've already noticed, and here is the opportunity that's actually coming to you guys right now, is that straight away, so actually before I get to that, the cost of construction is still increasing. So I don't know if you guys are aware, but on the 1st of April this year, China was giving a rebate on their exports for their 9% VAT, the equivalent of GST. So they were rebating that to the wholesalers that were exporting to Australia. That doesn't exist anymore. So the wholesaler has to absorb that 9% tax that the government was giving them as a rebate. So that means that all of the pricing of 260 odd categories of products coming from China to Australia, mostly for housing construction, have all increased. Then we've got, as you know, we've got fuel crisis, we've got fuel increases, the cost of living increase, and because of the cost of living and inflation, interest rates obviously are at the higher end. That means higher rents straight away, right? So it means that as investors, we're not affected by that. Disaster for a Labor government to be having these policies, but anyway, that's on them, right? They're gonna have to wear that, but that's obviously what comes with that. But from our perspective, we get more rent with increase in interest rates, and we also get to claim more. But what's happening is that the labor of construction costs is going up with the cost of supply of materials. So the cost of construction continues to increase, which again drives the market, right, in these areas. And already we've got builders and developers in their next release of apartments or townhouses, or the next release of land release that we get, everything, all the pricing is going up. And so what we've managed to do is position ourselves with all of the builders and developers that we have properties on our list right now. So any one time we've got about 250 to 300 properties on our list that have all been researched. They all meet our criteria, the 3 criteria and the high city scores. We've basically managed to maintain the pricing that's on our price list. So anything that's a property right now on our price list is actually being set, right? Anyone that comes later, right, then obviously those pricing, we know it's going up because the builders already notified us of their new pricing. So we are seeing across the board the pricing of construction going up immediately. Now, if you're already invested in these markets, that's already pushed up your value, right? And for those people that are seeing us in the next couple of weeks with the properties that we obviously still have managed to get a price freeze on, they'll then experience a price increase pretty much on signing the contract. So the moment they sign the contract, the value of it will go up straight away. So this is very, very real. And this is the first time you'll ever hear me say this, because I've never actually said this. But if you're waiting for us to reach out to you, you're crazy. You really need to reach out to us. If you're an existing client with us and you're investing in properties, it's a really good time for us to do a review. Some of you don't have self-managed super fund property yet. Some of you, we haven't got to the starting gate of giving you a strategy yet, or maybe we need to review the strategy. But either way, this is the perfect opportunity for you to be reaching out to us and saying, look, I really want to sit down with you and let's work out how we can sort of maximize what we're currently doing, because all of our clients, they are in a pole position because of obviously what our robust investment policy has been all of this time. And we are now going to see buyers agents now try and move into new properties. We're going to see other people in this industry that were sourcing residential established properties for their clients. Are going to see them trying to move into this industry. And it's going to be really interesting because they're going to not have the same experience that we do. They're not going to do the same research and due diligence that we do. I mean, just the amount of checks and balances that Tim and his team do on the audits of construction phases when we're actually taking on a new builder. I mean, I know buyers agents and they don't have that experience. They don't even have the knowledge to be able to do that. And also, we have the experience and the time of relationships of we need to really stay away from that guy, stay away from these people. These people build a really good product. They're really good to deal with, and they follow through, right? So we've got enough of that experience as well when we're in this sector. All right. So really, really good time for our clients because we're going to continue to see prices go up. That is a given. The interest rates are going up. Will it make properties more affordable for the younger generation like the government's trying to do? Well, I mean, that's up for debate. I laugh, right, when I say that because I don't know of any young people that actually really truly believe that either. I mean, Mark Burrows said this. I mean, there's loads and loads and loads of professional comments, right, on this budget. None of them positive. But Mark Burrows said something that I agree with, and it was very well said. And just to ad lib what he said something to the effect that there's two types of budgets. There are budgets that support the expansion of an economy, and then there's budgets that look at trying to wealth redistribute and take more tax. And that's exactly what this budget actually is. It's not. There's no legs in this budget. There's nothing long term about it that allows the economy to actually grow. And and it's got a lot of people offside, lots and lots and lots of people offside. I mean, we saw obviously the popularity go off, immediately after obviously the budget itself. That's a political conversation. I mean, look, my personal opinion is that all the politicians are bullshit artists. I just look at everything from a zoomed out point of view, and look at what's the opportunity here. It's like when COVID hit. And some of my clients got really, really nervous. And I said, come on, there's so many opportunities that are actually opening up as a result of this. And there were. And there were different phases of those opportunities. There was an immediate phase of opportunity like there is now, where literally everything that's on our list, we have a frozen price point. But then from that, there's going to be other opportunities that unfold that I'm not even aware of yet. But there will be, and that's obviously how we've continued to be strong as an organization. That's why we've got 2,600 clients, over 6,000 properties now, all growing really, really well, all cash flow positive, and still cash flow positive because people are still getting their tax credits. All right. So I wanted to take the opportunity of meeting you, for those of you that don't know me, and that we are very, very proud of obviously what we've done, what our position is. We don't even need to pivot. Right? We are just maintaining business as usual because it's a solid strategy no matter where we are in the economic cycle and no matter what messed up decisions governments make. We are here to obviously benefit from it because, again, it's get rich slow and look at things logically and not get obviously caught up in fear. A lot of people get caught up in fear and go, oh my God, oh my God, oh my God, they're going to accidentally gearing. Honestly, if they accidentally gearing their grandfather that decision across the board, as I said before, you would not be worrying about your property investment. You would be worrying about how on earth are we going to get money out of the bank, right? You'd be stocking up on gold. There'd be blood on the streets, as Rockefeller said many years ago. So you wouldn't be worrying about properties, right? It wouldn't matter if you're a renter or if you had 20 properties. If they took it out across the board, we'd have a banking collapse, and that would be a far bigger problem. And obviously, that sort of chaos. And that's why, like I said, we're in a much different position now than even back in 1985. Right, the loan to value ratio is a lot higher, and obviously this fractal reserve lending is very, very high compared to what it was back in the Great Depression. So, the government, even though it's an ambitious and audacious budget, it's not what they really would have liked to have done. I mean, I'm sure they would have liked to have axed it completely and all the rest of it, but it wouldn't have worked, right? There is no way that it would have worked because it would have collapsed the banking system. And I've just did an affiliate webinar before you guys and speaking to brokers, and everyone agrees, right? Like the banks wouldn't have allowed it to happen. They would have pushed back massively. And the irony is that the government implemented a guarantee on deposited funds up to $250,000 since the GFC, and it's still in place. So, it's just, I mean, there's stupidity, and then there's just, it's not going to happen. All right. So that's why, again, we're very, very proud of, obviously the guidance that we've given all our clients. And that's why, again, capital gains tax, we already had a strategy for that, right? And there's loads of different workarounds, all right? So it's not like if you invest in a property now, you can't avoid capital gains tax. 100% you can. It all depends on what your transition to retirement strategy is. That's what it all comes down to. But look at all the pushback from entrepreneurs in Australia where they've built up a capital gain from a startup and they're now sitting on an asset that's worth $600 million. And if they sold that, they're going to get taxed at 47%. I mean, they're all screaming blue murder. So it's going to be interesting to see how that rolls out. I say it all with a smile on my face because we're unaffected by it all, right? We get to spectate. But that's why we have all these very strict policies of where we source properties and how we train our clients. And I'm already getting swamped with obviously people coming to me, my own clients saying there must be opportunity that comes from this because they know me and they know me by now and they know that this creates opportunity and absolutely has. All right, guys, thank you very much for your time. I've gone a little bit longer than what I would have done. I've got about 15 minutes over, but I think it was worthwhile. Maybe we'll look at doing this on a more regular basis. If you'd like me to do a webinar more regularly, how about you reach out to us and just let us know? And based on that feedback, we'll look at doing something more regularly, all right? Like a quarterly or monthly webinar for everybody. Other than that, enjoy and reach out to us, right? Because don't wait for us to try and chase you. We need to review your strategy and we need to obviously look at ways in which we can maximize this opportunity for you. All right.